By late 2025, three separate alarms were already sounding simultaneously in different corners of the financial system. Most Americans didn't hear them, not because they're stupid, because the system is designed to be quiet until it's too late. Alarm number 1, equities. In New York, stock market valuations have been pushed into territory that echoes the most dangerous moments in financial history, not just 2008, not just 2020, the kind of valuation stress you associate with 1929 and the dot-com bubble. The S&P 500 has been trading near extreme levels on long-term valuation measures like the Shiller Cape, the kind of levels that don't last forever. Not because markets are moral, but because math eventually collects its debt. Alarm number 2, commercial real estate. Across office corridors from San Francisco to Austin, valuations have been cut in half in places where demand never came back. The buildings are emptier, the rents are weaker, the refinancing terms are brutal. But the losses haven't fully hit the system. Not yet. Because many of those losses have been delayed, pushed forward, rolled into temporary fixes. Extend, pretend, repeat. Alarm number 3, refinancing. The bond market is facing a wall, a deadline, a moment where trillions of dollars in corporate and real estate debt have to be rolled over into a world of higher rates. And here's the killer. They borrowed that money at 2%. Now they have to refinance it at 6% or 7%. That's not a market narrative. That's not a headline. That's not a vibe. That's arithmetic. This isn't just a recession. This is refinancing math colliding with reality. Economists call what we're living through the everything bubble. And here's why that phrase matters. In 1929, stocks crashed, but bonds were a refuge. In 2008, real estate crashed, but government debt and long-duration bonds became the escape hatch. In 2026, the problem is bigger. Stocks, bonds, real estate, and private markets have all been inflated by the same force, cheap money. And when everything is inflated by the same force, everything reprices when that force reverses. The real problem isn't just valuation, it's correlation. When rates move, everything moves. When the cost of money rises, the discount rate rises, financing breaks, liquidity dries up, and the bubble doesn't pop in one place, it cracks everywhere at once. Today, we're going to perform a forensic audit of the everything bubble. We're going to look at the key indicators flashing red right now. We'll break down the mechanism that created phantom wealth. We'll expose the maturity walls hitting the system through 2026 and into 2027. And I'll show you why this time the Federal Reserve is entering a crisis with far less ammunition and far fewer clean exits than the public believes. Because 1929 was a market crash. 2026 is shaping up to be a balance sheet crash. Back then, leverage was in investors. Today, leverage is in the system. To understand why the next downturn is structurally different, you have to understand the illusion we've been living inside. You look at your 401k, and it looks fine. You look at your Zillow estimate, and your house looks valuable. You open a brokerage app and see green numbers. It feels like wealth. But a large portion of that wealth was engineered by one thing: the cost of money. For more than a decade, interest rates sat near zero. The system was flooded with liquidity. Debt was cheap. Capital was abundant. And any asset with a cash flow, or even the promise of a future cash flow, got priced like it was immortal. This is how the everything bubble was built. Now look at the Buffett indicator, total market cap divided by GDP. Historically, around 100% is considered fair territory. Before the dot-com crash, it surged. Before major stress events, it spikes. Today, it's not just elevated, it's been sitting at extreme levels, well over 200%. That means the stock market is priced at more than double the productive output of the economy. And that gap creates what I call phantom wealth. Wealth that exists on paper but cannot be exited cleanly at scale because there isn't enough liquidity in the real system to cash everybody out at those prices. And here's the part most people don't understand. The mechanism that inflated the bubble is the same mechanism that can accelerate the crash. For the last decade, the market has been slowly transformed into a machine, not a forum where humans debate value, a machine, driven by flows, powered by automatic buying. The rise of passive investing and index concentration means trillions of dollars are now allocated mechanically. These funds don't care about price. They don't care about fundamentals. They don't care about valuation. When money flows in, they buy, and when money flows out, they sell. Automatically, mechanically, regardless of price. And the system has another accelerant stacked on top. Options flows, volatility targeting, gamma hedging, reflexive market structure. In plain English, when volatility rises, the system is forced to sell into the drop. When the system sells, volatility rises more, and the selling intensifies. A feedback loop. A market that can liquidate itself. This is why modern crashes don't drift down. They gap. They snap. Now look at the top of the market. The Magnificent Seven. For years, these companies have been the engine of the entire index. They represent roughly a third of the S&P 500. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. Not only do they carry the index, they carry passive flows. They carry sentiment. They carry the illusion that the market is diversified. But it isn't. It's concentrated. And these giants are priced for perfection. Perpetual growth, perfect margins, perfect execution, no interruptions. But growth slows, margins compress, competition rises, supply chains break, demand cycles turn. And when the market realizes perfection isn't real, the unwind doesn't stay inside 7 tickers. Because passive exposure spreads the damage into everything. When a top holding drops, the index drops. When the index drops, funds sell. When funds sell, correlations spike. This is how your retirement portfolio becomes collateral for a market structure problem. The illusion of wealth looks stable until the exit door gets crowded. Stock bubbles can last longer than you think, but debt bubbles have one thing stock bubbles don't: a deadline. And the deadline is driven by refinancing. Right now, the U.S. financial system is sitting on a ticking time bomb called commercial real estate. During the pandemic, remote work rewired behavior. Office demand never fully returned in many markets. Vacancy rates surged. But the price collapse hasn't fully cleared the system. Why? Because the banking system can delay recognition. It can restructure. It can extend maturity dates. It can pretend the collateral is still worth something close to its old mark. This strategy has a name: extend and pretend. The problem is you can't pretend forever because refinancing arrives. A large volume of commercial real estate debt matures across the 2024 to 2027 window, with major stress points building toward 2026 and 2027, depending on the dataset. And when those loans mature, the game ends. They don't get reevaluated, they get repriced, because refinancing forces the market to admit reality. And the reality is brutal. A building that once refinanced at 2% can't survive at 7% without either rents exploding or the purchase price collapsing. And rents aren't exploding. In many cities, rents are weak, and the buildings are emptier, so the price collapses. That collapse creates a valuation death spiral. One building sells at a massive haircut. That becomes the new comp. The new comp forces repricing across the entire neighborhood. And suddenly the bank's collateral isn't down a little, it's down 40%, 50%, sometimes more. Now imagine what that does to a bank balance sheet. Regional and small banks carry a disproportionate share of CRE exposure. And CRE is not a small asset class problem. It's a foundation of credit problem. When those loans get marked down, capital gets eaten. Not slowly, all at once. Because equity buffers are thinner than people think. And once a bank looks impaired, the next crisis arrives instantly: confidence. In 2008, bank runs happened on TV, in lines, over days. In 2026, bank runs happened through apps, in seconds, quietly, then all at once. You saw a preview of what digital panic looked like in 2023. That was one bank, one narrative, one concentrated customer base. Now imagine dozens of institutions under pressure simultaneously. When banks fail, credit freezes. When credit freezes, small businesses can't finance payroll. And when payroll breaks, the economy breaks. This is the mechanism that turns a market correction into something darker. A credit crunch, a recession that feeds on itself. Not because people suddenly forgot how to work, but because the system that funds work stops functioning.
Here's the myth Wall Street is selling the public. If the market crashes, the Fed will pivot, cut rates, print money, and everything will go back up. That myth was built on 2 decades of conditioning. In 2008, the Fed slashed rates to zero and flooded the system with liquidity. In 2020, they did it again, at historic speed. So people assume the next crisis gets the same response. But this time, the Fed is entering the room with constraints. Not moral constraints, structural constraints. The U.S. national debt is far higher than it was in 2008, and debt servicing has become one of the largest and fastest-growing line items in the federal budget. At the same time, inflation has proven it isn't a ghost you can dismiss with a press conference. It's sticky, structural. Energy, housing, insurance, supply chains, wages. So now the Fed faces the trap. If they cut rates aggressively and reopen the money printer, they can stabilize asset prices, but they risk reigniting inflation. If they refuse to cut rates and refuse to inject liquidity, they can fight inflation, but they risk financial stress spreading into systemic failure. The public thinks this is a debate. It isn't. It's a choice between 2 forms of collapse: a collapse in markets or a collapse in purchasing power. And history tells us what institutions choose. They choose system survival. They choose stability of the banking core, even if that stability is purchased by destroying the value of money. That's the soft default. Not a formal default, not a missed coupon payment. A default through dilution. The government doesn't tell you it defaulted. It pays you back in currency that buys less. And that's what makes the everything bubble so dangerous. Even if your portfolio recovers in nominal terms, your life can still get poorer. Your stock chart can go up while your groceries become unaffordable. Your home price can rise while your real purchasing power collapses. This is the part the charts don't show. A crisis doesn't have to look like a crater. It can look like a slow suffocation. And in a high-debt world, suffocation is often the politically acceptable solution. So how does this play out? This isn't prophecy. It's what maturity walls and past cycles tend to produce when financing conditions tighten. Here's the most likely sequence. Phase 1. The denial. Early 2026. Markets remain elevated. Media keeps talking about soft landing, but corporate earnings begin missing. The consumer hits the wall. Not because consumers are lazy, but because the stimulus impulse fades, savings run down, and debt costs rise. Delinquencies trend up. Stress quietly builds underneath the surface. Phase 2, the trigger, mid-2026. A major regional institution stumbles under CRE exposure, or a large borrower fails to roll over debt under new terms. Not because they're evil, because refinancing math kills them. The maturity wall claims its first visible victim. Markets wake up. Confidence cracks. Phase 3, the cascade, late 2026. Passive flows reverse. Funds sell mechanically. Options markets amplify volatility. Hedging flows intensify selling pressure. The Magnificent Seven unwind, and because they are embedded in everything, the entire index follows. Then comes the hidden accelerant, margin. When markets drop fast enough, margin calls force liquidation. Investors sell good assets to cover bad ones. Everything becomes correlated. Even the safe trades wobble at first. Gold can drop initially as people sell what they can for cash, then reverse violently as trust in currency deteriorates. Phase 4, the bottom, 2027. Eventually, the Fed responds, but the response doesn't land the way people expect. The next wave of liquidity doesn't necessarily inflate the exact same assets again. It leaks into the real world: commodities, food,
Energy. We enter the regime nobody wants, stagflation. Weak growth plus inflation pressure. The environment where the classic 60-40 portfolio stops behaving like protection. Bonds don't hedge because inflation eats them. Stocks don't hedge because earnings collapse. The everything bubble doesn't end with one asset breaking. It ends with the system repricing the meaning of safe.
If the everything bubble is real, then the traditional playbook is dead. So what survives when everything falls together? Not what wins, what survives. We look at the positions that historically survive when the system is forced to choose between liquidity and inflation. 1. Cash, short-term treasuries. In the initial phase of a crash, cash is optionality. It is the ability to move when everyone else is forced to freeze. But cash doesn't mean sitting exposed inside fragile balance sheets. It means cash-like instruments with minimal duration risk and maximum liquidity. In crashes, the ability to wait is power. 2. Hard assets, gold and silver. Hard assets aren't magical, they're structural. Gold is the only asset that isn't someone else's liability. It doesn't default. It doesn't need a counterparty. It doesn't need an issuer. When the system solves insolvency with dilution, gold doesn't go up. Currency goes down. Gold just shows you the truth. 3. Productive real assets, not speculative office towers with collapsing rents. Productive assets, the things the real world actually needs. Energy infrastructure, essential goods producers, hard supply chains, productive land. Assets that don't rely on cheap refinancing to exist. Because that's the lesson of the everything bubble. Anything that requires permanent cheap money dies when money is no longer cheap. The window to prepare always closes before the public believes it exists. And in every cycle, the unprepared pay twice. First through losses, then through inflation. The crash of 2026 isn't about fear, it's about structure. A mathematical consequence of leverage built on a price of money that no longer exists. You can't stop it, but you can refuse to be the passive casualty. Because the system is designed to transfer wealth from the unprepared to the prepared. Which side will you be on? Hog out.